don't tell anybody. In today's video, I'm going to walk you through the secret math to help you decide whether a Roth IRA or a regular IRA is right for you. Let's go for a walk. You know, I think a lot of people are going to be very shocked to hear that if you believe tax rates are going to be the same for your entire life, your tax rate is going to be the same for your entire life. Believe it or not, you are indifferent between the Roth and the regular IRA from the tax benefit standpoint. And later in the video, I'm going to walk you through some quick math to demonstrate that for you. But let's just stay with me now because I don't want to get too technical early in the video. So if the math is the same, if the tax consequences are the same, why do financial advisors like myself make a big deal about whether you should have your money in a Roth or a regular IRA or Roth or a regular 401k? And even if you think tax rates for yourself are going to be the same, there are reasons to have both of these accounts. And this isn't financial advice. I don't know your situation, but I want to put this on your radar screen so it's something that you're thinking about. So if you believe that the tax rate is going to be the same for you in the future than now, you still want to have, I would argue, both of those accounts, because the regular IRA gives you the tax break early on, right? But then when you take the money out, you have to pay tax on it. But here's the thing: when you're in retirement, unlike when you're working for somebody and you're getting W-2 income, or even if you own your own company, in retirement, you have a lot more levers to control what your taxable income is going to be. Assuming you have money that outside of just a regular IRA or a regular 401k. So if you have money in a regular IRA, in a Roth IRA, as well as maybe a taxable bank account, you can look at those three accounts, what I call three buckets, and say, what tax rate do I want to pay? And some of the tax rates are quite low. And so you want to do a strategy that financial advisors call filling up the low tax brackets. So even if the math is the same, as I said earlier, you still want, I would argue, you want to have both accounts. Now the trick is how much is in each account. And for that, you need to see a financial advisor. I would suggest you Google fee-only financial advisor to figure out, what percent of your assets should be in a regular IRA or a regular 401k versus the Roth version of that, versus after-tax money like in your bank account or at a custodian like Schwab or Fidelity. But let's go through the quick math and just high level. Let's say that you've got $100,000 that you could either put into a regular IRA or a Roth. Let's do the Roth first. So you've got $100,000. You don't get a tax break when you take money out. And let's assume that you take that the tax bracket is 40% on the way out, just for easy math. So you've got $100,000. Let's say that $100,000 grows to $200,000. So you put in the $100,000. It grows to $200,000, but then you don't have to take, you don't have to pay tax on the way out. But if you've got the $100,000 and you're in a 40% tax bracket, you can really only put in $60,000. Hopefully that makes sense. So $60,000 doubles, you get $120,000. Now let's take the regular IRA. In this case, if you've got $100,000 that you can put in the account, you don't pay any tax, so you can put the full $100,000 in. It doubles, you've got $200,000. But again, if your tax rate is 40%, in this case, $80,000 is going to the government. And guess how much money you have at the end? It's the same $120,000, right? So there's an adage in my industry, people that are trying to sell you one tool or the other, they'll lay down a $1 bill, a $5 bill, and a $20 bill and say, which of these do you want to give to the government? Well, of course you want to give the $1 bill. You don't want to give the $20 bill to the government. But it's not that simple. As I just showed, if your personal effective tax bracket is the same. Now, again, it gets super complicated because what your income is also going to impact the taxability of Social Security. So there's a lot of reasons outside of just this simple example that I gave you here. So I think for most people, again, you want to have all three buckets so that it gives you a lot more control. And unfortunately, you know, for my generation, for people my age, and I'm in my late 50s, we were all taught, you know, put as much money into your 401k as you can. And I think that was good advice. You know, the Roth version of the 401k, the Roth version of the IRAs weren't available when we were young and our parents were giving us advice. So a lot of what that advice came from is that oftentimes employers will match maybe 2% or 4% or 6%. I've seen as high as like 10% in some accounts. Usually like universities, maybe medical groups will have a really nice match. So that's where the advice came from. But because of that now, I see people that are 50 or 60 or 70 and almost all of their retirement assets are in a regular IRA or a regular 401k. And that limits your flexibility in retirement. Another thing that you want to look at, not just the percentages, but how your money is invested. Now, there are certain tax advantages, like if you're going to hold a bond that's going to pay interest, would you rather hold that in an account that you're never going to pay taxes on, or in an account that, like your bank account, that you're paying tax on that interest every year? So the theory would say to hold the current income investments in an account that you're not going to be taxed on, in one of these tax deferred accounts. And the math works out there. The thing you also have to factor in is we are not robots. We're not calculators. We are human beings and with emotions and with heart. And you just have to ask yourself, are you going to be able to stay the course if, you know, all of your stock investments are in one account, and then the bonds, which are supposed to provide stability for you, are in another account? I would argue most people are better off having their asset allocation pretty closely matched in each account, so no account is down hugely when the market is scary, and you need to be, the importance of staying the course is the highest. So that's my thoughts on it. Again, hopefully you found helpful the tax bracket example here. And I also think you'll find this video next to the Eiffel Tower here super helpful as well, which is the average retiree income. Thanks for watching this one, and I'll see you in the other video. Bye-bye.